You're sitting there at 3:25 p.m., watching the Nifty close right near a major psychological level. The market is about to shut, and you have to decide whether to carry that position overnight. Right now, we're hovering at exactly 24,614.9. The choice is binary but brutal. Do you bet on a gap up to clear the hurdle tomorrow morning, or brace for a gap down? Most retail traders fall into the same trap here. They try to guess tomorrow's opening tick by reading global headlines or going with their gut feeling. The simplified sentiment tags you see on your dashboard are clashing with the underlying structural mechanics of the market, creating a trap for anyone following the surface-level labels. If you base your overnight hold on just one side of that equation, you drastically increase the risk of a severe drawdown at 9:15 a.m. We need a better way to look at the numbers. It is very easy to look at a trading platform, see a green tag that says bullish or getting stronger, and feel safe holding a long position. But those summarized tags often ignore the heavy, raw volume moving underneath. When you only look at a summary of what domestic institutions are doing, you miss the actual structural mechanics happening across the wider options chain. To figure out what's really happening, we need to map this out on a matrix of risk versus probability, anchoring our current spot price of 24,614.9. If you input a strategy relying solely on basic sentiment tags, the trade-off is that you completely ignore the real volume data. That is exactly how traders get trapped in the first 5 minutes of the open. To avoid getting caught, we have to take the raw domestic institutional investor data and pit it directly against the broader open interest to see which force is actually in control. Let's look past the summary tags and examine the exact numbers the domestic institutional participants are putting on the board. This table shows their positioning. In the future index long row, dropping over 12,000 contracts means drastically less support for a rally. Further down, they hold 48,525 long puts and 0 short puts. They hold massive downside protection, refusing to defend the current market level. You might see a small bump in call options and think the smart money is bullish, but combined with 0 put writing, the reality is they are positioning highly defensively. The institutional data reveals a complete lack of conviction from buyers. This significantly lowers the probability of a safe, sustained gap up tomorrow. But institutional data is only half the story. We have to cross-reference it against the broader market's open interest as our ultimate reality check. This chart displays open interest distribution. At the center spot price of 24,614, you see a massive red bar extending downward. Up top, the shift is clear, a put open interest change of negative 6.78 crore. This is aggressive put unwinding. When nearly 7 crore put positions are closed out this fast, the structural support vanishes instantly, creating a vacuum underneath the current price. Compare this intense market panic against the mildly defensive DII data we looked at earlier. The broader market fear is clearly the dominant force here. This extreme unwinding breaks the support level entirely. It creates a high probability bearish bias and paves the way for a sharp downward slide right at the opening bell. Professional traders don't try to guess the exact opening tick with perfect accuracy. Instead, they map probabilities based on the data we just analyzed. Let's lay out tomorrow's battlefield. Our anchor is 24,614. Resistance sits at 24,700, while broken support pushes next zones down to 24,500 and 24,400. If Qs open negative, expect a gap down. Put unwinding will drive the price toward those lower support zones. If global Qs somehow open highly positive, the put writers who panic today will be trapped, triggering wild, unpredictable volatility in the first 15 minutes as they scramble to react. By mapping these two specific, data-driven scenarios, you protect yourself from emotional reactions, regardless of how that first candle opens. If you are an aggressive trader, your strategy is looking for a short entry near the 24,600 breakdown to capture the downward momentum. The trade-off is accepting the risk of sudden short-covering spikes. For conservative traders, the plan is to wait 15 minutes after the open to confirm if new put support is actually being written. The trade-off is missing the initial move, but you ensure capital protection against morning fakeouts. This screen shows a critical final step. Before executing any of these scenarios, you must verify these structural maps with your own real-time data. Success depends on following the map and verifying these levels with real-time volume before taking a position. Synthesizing institutional positioning with raw market interest provides the clarity needed to navigate the morning gap without relying on guesswork. Plan your levels, wait for